I am Peg Gallagher from Omaha. Mr. Buffett, are you interested in influencing Mr. Greenspan at the Fed to stop raising interest rates?
Well, I wouldn't have any influence with him. He was on the board of Cap City some years ago, and I know him a bit. But I don't think anyone would have any influence with Mr. Greenspan on that point. But I generally think that his actions have been quite sound during his period as Fed chief. I mean, it's part of the job of the Fed, as Mr. Martin said many years ago, is to take away the punch bowl at the party occasionally. And that's a very difficult policy to quantify, working with markets day by day. And of course, it's always been the job of the Fed basically to lean against the wind, which of course means if the wind changes, you fall flat on your face. But that's another question. But I think what he has done has probably been somewhat appropriate. I think he's probably been surprised a little bit as to what has happened with long-term rates as he's nudged up short-term rates. I think he was hoping that, this is just a guess on my part, that action sort of early in the cycle on the short-term rate front might make people feel more confident about the longer-term rates, and therefore that the yield curve would flatten some. I don't know that. And he may have been a little surprised on that. But it's not an easy job he has, so I would not second guess him myself. Charlie, how do you feel about him?
Fine.
Greenspan is safe. Zone 6.
Mr. Buffett, I'm Lee Miller from St. Louis. There was an article in the April 18th Barron's that attempted to calculate the value behind each Berkshire Hathaway share. I'm sure you have some views on that, and I'd be very interested in your perspective on that issue.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago, reaching pretty much the same conclusion, and I hope he hasn't been short in between. But I would say this: it is not the way I would calculate the intrinsic value of Berkshire, but everyone in securities markets makes choices on that. Every day somebody sells a few shares of Berkshire and someone buys, and they are probably coming to differing opinions about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not total. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane. Zone 7.
I'm Edward Barr from Lexington, Kentucky, and I'd like to ask, given the amount of capital in the banking industry, do you think that more banks should be buying back significant amounts of their stock, like SunTrust, versus just the token amounts that they're buying back, or just the authorized amounts? And then also, related question in banking, are banks too focused on goodwill amortization when declining to buy other banks for cash, thereby using purchase accounting, versus the normal practice in the industry of pooling accounting, even when the stock that they issue may be depressed or undervalued?
Well, the first question about the capital in the industry, that you really have to look at that on a bank-by-bank basis, and there is a lot more repurchasing of shares by banks taking place. You mentioned SunTrust, but National City They bought it back, I think 5% of their National City of Cleveland bought back 5% of their stock in the first quarter. There's much more repurchasing going on, and that's simply a judgment call by management that as to the level of capital they need going forward and what level of capital enables them to earn the return on equity that they think appropriate, and what they feel like paying for their own shares. So I think you have to look at that on case by case. We certainly like it. If we were to own a bank, we would, or own shares in a bank, we would like the idea of the bank repurchasing its stock at a price that we thought was attractive. We would think that they probably knew more about their own bank than some other bank they were going to buy, and that if the numbers are right, it's an attractive way to use capital. Your second question about goodwill amortization and purchase accounting versus pooling, we care not. At Berkshire, it absolutely makes no difference to us what accounting treatment we get on something. We are interested in the economics of a transaction. Some banks, some businesses generally, most businesses perhaps, prefer pooling because they don't like to take a goodwill amortization charge. We think our shareholders are smart enough, particularly if we make it clear to them the accounting consequences. We think they're smart enough to look through to the economic reality of what Berkshire's businesses are all about. And I think that some managements sell short their own ownership group by doing various kinds of financial acrobatics in order to have the charges come in a certain way rather than, as you point out, often they might be better off buying for cash rather than their own stock as currency, but they may prefer to use their own stock because they avoid goodwill charges. We've written a few things on goodwill in the past, in past annual reports that might get to that subject. We don't care what accounting. We sort of rewrite the accounting for any business that we're looking at, because in our heads we want to have, in effect, a standardized way of looking at businesses. And if one company goes through pooling transactions and another goes through purchase transactions, we're going to recast them in our own mind so that there's comparability. Charlie?
Yeah, the published accounting results are in accordance with standard convention, and they're a place to start economic analysis. The figures are frequently quite silly on a functional basis. I'm not criticizing accounting conventions except for some. Yeah. But I think it's just a place to start thinking about economic reality. By their nature, they can't tie perfectly. They can't even tie very well to economic reality.
We regard it as a negative when we find a management that's preoccupied with accounting considerations, but we find it so frequent that we can't afford to use it as a total exclusionary factor. It really surprises me how many managements focus on accounting and the time they spend on it. It's really unproductive. If you find a management that doesn't care about the accounting but does explain to you in clear terms what's going on, I think you should regard that as a plus in owning a security. Zone 1.
Mr. Buffett, my name is Bill Ackman. I'm from New York City, and my question relates to the appeal of Salomon Brothers as an investment. You talked earlier about leverage and the dangers of leverage. Salomon is a business which is levered 30-to-1, which has very narrow margins and earns a relatively modest return on equity in light of the amount of leverage that they use. What is the appeal of the business to you?
We have here today the chief executive of Salomon Inc., the parent company, and also the chief executive of Salomon Brothers, the investment banking arm. And I would say one of the things Charlie and I feel extraordinarily good about are the two fellows that are running that operation. They did an exceptional job under extraordinarily difficult circumstances, as did John McFarlane, who's also here today. The three of them, I mentioned 4 people in the annual report, and Salomon wouldn't be here today without those three, and it wouldn't be the company in the future that it's going to be without them. And they did an absolutely fabulous job. It's the sort of business that, as you point out, uses a lot of leverage. It doesn't, in one way, it doesn't use as much as it looks like. In another way, it uses even more than it looks like. But the test will be, A, whether they control that business in a way that leverage does not prove dangerous, and secondly, what kind of returns on equity they earn while using it. You certainly should expect to earn somewhat higher returns on equity when you are necessarily exposed to a small amount of systemic risk and significant amounts of borrowed money than you would in a business that's an extremely plain vanilla business. But I don't know whether you've met Bob and Derek, but I think you'd feel better about having leverage in their hands than about any other hands you can imagine. Charlie?
Why don't we have those three gentlemen stand up?
Yeah, you ought to give
they
them a
really
hand.
have done a job
Yeah.
for Berkshire in this last year.
I'll leave the applause for them. Where are they? There they are. I mentioned this before, but it's worth mentioning again. Derek took on the job of being the operating head of Salomon Brothers on August 18th, 1991. He couldn't know what he was getting into exactly. 2 months later or 3 months later, we never had a conversation about compensation. He did not ask me for Berkshire or my guarantee for indemnification because he was walking into unknown legal problems. We didn't know what we would finally uncover. And he worked incredible hours to keep that place together, which was not easy. Bob Denham, I called, I guess, on the 23rd or so. I called him on a Friday. I got home on a Saturday, the 24th of August. He was living a nice, pleasant, peaceful life in California, and had a first-class law firm, good group of clients. Wife had a good job there, and I told him I was in a mess and there wasn't any second choice. And 3 days later, he was back in New York and living in a small apartment in Battery City and handling the general counsel's job at Salomon. They found John McFarlane on that Sunday on the 18th. I think he was running in a triathlon or something. Not a practice that Charlie and I follow, but and he was yanked from that and came down. And I think John lives over in New Jersey, but he holed up in the downtown athletic club, and it was his job to keep funding what was then a $150 billion balance sheet during a period when people right and left were canceling us, not because we weren't a good credit, but because they just didn't want to have anything to do with us for a while. And the World Bank and the State of Texas Pension Fund and CalPERS, all these people were shutting off funding at a time, and funding in a business, as the gentleman just indicated, is the lifeblood of an enterprise like Salomon. And so those three deserve an enormous hand, really by the Salomon shareholders, but by this group in turn, because we have an important investment in. So I thank them publicly.